losing my mind, losing control. One more spoon of cough syrup now. Whoa, whoa.
Good morning. I think it was a little bit of an omen. They brought us out here to speak and we had to walk through the kitchen. I think that was a reminder that we're the last panel before lunch and do not run long. So we'll try not to do that. So the title of this panel is Cash on the Sidelines, How to Unleash $30 Trillion. The original moderator was one of my colleagues and partners, Tim O'Hara. I am not Tim O'Hara. I'm Joe Reece. Tim's in New York, a little under the weather. So I was in London yesterday and I got a call saying, "What are you doing tomorrow?" And I said, "Well, I don't know. What am I supposed to be doing?" They said, "You're going to go to LA and speak at the Milken Institute." So here I am, so thank you. Fortunately, I didn't have too much to prepare because I've got 4 very able panelists. I'm going to introduce them quickly. I'll tell you a little bit about their background. I'd like to talk a little bit about the panel, what we'd like to do today in terms of sort of setting the table, our goals for the panel, what we'd like to do. And then we'll get into it. I've got a few questions I'm going to ask each of them. We'll talk a little bit about their views on the markets, my favorite phrase, risk on. And then I'd like to open up to questions. If any of you have questions from the audience, we'd like to make sure that you have a chance to ask the panelists. So real quickly, to my left is Mustafa Sagun. Mustafa is the Chief Investment Officer for Principal Global Investments in Des Moines, he told me this morning, which is very important to remember. As Chief Investment Officer, Mustafa oversees $60 billion in assets for the firm. He has a responsibility as a portfolio manager. He directly oversees over $4 billion, principally on the equity side. So for those of you who are looking for places to put money on the equity side, Mustafa might be a good place to start. To his left, Alexandra Lebenthal. She is the CEO of the eponymous firm named Lebenthal & Company. Did I say that right?
Yes.
We talked about that. And I'll tell you a little bit more about Alexandra. In addition to being the CEO of the firm that she reinvigorated and restarted after her parents and grandparents sold the firm that was started in 1925, we both live in New York together, and I was having breakfast at Park Avenue Spring last Friday. And I'm sitting there talking to a client, and in walks Alexandra with a camera person trailing her. So that'll kind of give you an idea of our media-savvy panel. Next to her is Max Stone. Max Stone's a managing director, and he's an executive committee member of D.E. Shaw. D.E. Shaw is a $30 billion asset management firm. Colloquially, we would call that a hedge fund. And Max is actually the head of the $6 billion discretionary macro trading strategy. And then finally, Jim Zelter. Jim's a managing partner of Apollo Capital Management. You would probably call that a BDC. The Apollo group of companies has over $60 billion of capital under management, and Jim's group has over $3 billion that goes to the SME group, small and medium enterprise. So that's our panelists. Let me set the stage just a little bit. It's funny, I called my sons this morning. I hadn't seen them since I was on the road, and my sons are 11 and 12. And usually at our house at breakfast, topics revolve around sex, money, and sports. So my oldest son, who's 12, when I called him this morning before he went to school, I said, so I'm in LA, I'm at this milking thing, and I explained to him what I was doing, and he said, that's really interesting. Are there going to be any pro athletes there? I said, probably not, but probably a few people that own sports teams. He said, good, get me some tickets, and he hung up. So that'll sort of sum up how important I think I feel today. The good news is, like I said, we're going to have the panelists all with a view about how to unleash this 30 trillion. Where did we come up with this 30 trillion? You know, it's funny. By most measures, you'd say 30 trillion is a pretty large number, but I actually think we're understating the amount of cash on the sideline. We've got a chart up here that shows EMEA, the US, and China, the money supply. And what we've basically done is we took all the time deposits in those regions and we stripped out currency. What's interesting is this doesn't include Brazil, Russia, Indonesia, Japan, a lot of other large economies. So I actually think the number's probably closer to 43 to 45 billion. But when you start, trillion. But when you start talking 40 trillion, I'm not really sure that it matters. Suffice it to say, there's a lot of money on the sideline, and I think our panelists are going to help us tell where to put it. The next slide, if we take a look, you can see, in addition to a large supply of cash on the sidelines, corporates, and this is an example from the US sector, but the same statistic will hold true when you look at corporates globally. In fact, what's interesting, if you look at the 5 largest companies by market cap on NASDAQ, Google, Cisco, Apple, Microsoft, and Oracle, those 5 companies alone, according to the latest 10Ks for the last fiscal year, are sitting on about 340 billion of cash, just with 5 companies. And that's a trend, again, that's playing out throughout both corporate America and corporate global. Next slide, please. It's not just corporates that are hoarding. This is a great slide showing what our commercial depository institutions are doing and the loans they're making. And we were talking as a group of panelists in the back. About 2 weeks ago, the Obama administration put out, I guess, a position saying, geez, we'd love to see more credit being provided to the mortgage sector for non-traditional borrowers. And we all kind of looked at each other and said, didn't we see that movie before? So I think, look, there's also a lot of capital in the depositories not being put to loan capital. Next slide, please, Peter. Look, this is an interesting slide, monetary policy, what it's showing on real interest rates. I think a better slide would show the 10-year Treasury from 1790 to today. Other than 1835 through 1837, when we had no national debt, we're at a 223-year low on the 10-year. Last year, in fact, in July, July 24th, it hit 1.39. Today, it's about 1.65. I don't know about you, but my gut reaction tells me this is not sustainable, and I think some of our panelists will agree with that. Next slide, Peter. So, originally, I heard that the topic, quote, the Great Rotation, has it begun? The idea for the panel was put forth by a couple of panelists about 9 months ago, and then refreshed 6 months ago. I'm an equity guy. I run our global equity capital markets business at Credit Suisse, and so by definition, I'm paid to be optimistic. And I love it when people say, oh, are we risk on? I didn't ever really know that we went risk off, and I think a lot of people confuse credit ratings with credit quality. But if you look at just the sheer flow of capital, and this is a chart from the US because the US has the best information, best statistics. Last year, there were 7 positive weeks of funds flows for a negative $65 billion into the equity markets and active managed in the US. This year, year to date, 15 of 17 weeks have been positive and 28 billion. The emerging markets funds based in the US, 11 of 17 weeks have been positive, 24 billion. So if you think about the, quote, risk on being people putting money to work in the equity capital markets, I would say we're definitely risk on. Peter? Next slide. Interestingly enough, personal savings is back to pre-crisis levels, and I'm not sure if that's a good or bad thing, but when you're earning 28 basis points on your passbook savings account, I guess there's not much incentive to keep your money in your depository. Peter, next slide. So, what do we want to do? Look, we'd like to have these folks up here define exactly what is the amount of cash and is it truly on the sidelines. Next, we want to talk a little bit about the pressure to invest. We could have just as easily called this program the hunt for alpha, because all of you know when you're in a virtually zero interest rate environment, it's really tough to generate yield. We'd like to consider ways from a policy standpoint, from a product standpoint, from an innovation standpoint to spur that. And finally, we want you to have a good time, right? We recognize this is the last panel before lunch. We were reminded of that on our way in, so we'll try not to run too long. And we also want to have you, give you an opportunity to ask questions. So with that, and I've written a couple of questions out. I'd like to start off. I'm going to start with Max. When you think about the definition and quantity of cash on the sidelines, how do you think about that? How do you quantify, and how do you think about what is on the sidelines?
Yes, we do. I mean, notwithstanding the title of the presentation and notwithstanding your belief that it should be even bigger, I think the relevant number is still big, but smaller than 30 trillion. Like, fine, there is a lot of M2 in the world, but it's not like that is all money that's available to be pushed into more productive investment. So I'd say the more relevant number is, well, what's the excess cash on the sideline? What's the actual amount that, beyond what's normally there that could be pushed into doing something more productive? And I think that breaks down interestingly in different types of institutions. Like in the US, for example, you would look at households, and I think you could easily come to the conclusion that there's no excess cash there. There's cash there, but it's kind of the normal amount of cash there. People aren't really crying for people to run their savings down. Well, it's hard to call investment running your savings down, but to take on more risk in households. If you look at financial companies, there is more cash there than usual, but I think that's mostly intentional. I mean, we've told the banks that we need them to delever and be less risky. And so I think that's also not obviously cash on the sidelines, although I think that's more debatable. I think where the cash lies, at least in the US, is on the corporate balance sheets, the non-financials that you mentioned, the 5 NASDAQ names, and you had, I think the second graph was showing how much those cash levels have risen. I think that's a genuinely, it's not 30 trillion, but if it's probably 600 billion more cash than kind of a baseline amount of cash that's in corporations. So I think that's a still interesting amount to unleash. And then I think internationally you might add other things, like you didn't even have Japan on the slide, but Japan would be one of these places where they've had decades of really high savings and decades of, the last 6 weeks notwithstanding, they've had decades of falling equity prices. And so it's become this very risk-averse mountain of yen. And I think that's, even without adjusting for the fact that Japan is a smaller country than the US, there's probably a higher number there. So,
Mustafa, I'm going to turn to you, given your role managing primarily equities on the long-only side. When you think about the quantity and the definition of cash on the sidelines, is it on the sidelines? How much is it? How do you get access to it, et cetera?
I think there's some cash on the sidelines, but let me define, very similar to what Max said. I think when I think about cash or cash interesting to us, really it's low returning assets actively looking for higher returning alternatives. So are they available is the key question. And I think maybe that number is 1 or 2 trillion. I tried to quantify it. It is hard to quantify because the question is, even if there is some on the sideline, is it available? So that's where we need to use a little bit of judgment. But also just because of that, we mentioned, I'm on the equity side too. I would love to see a great rotation, but I don't think it will be a great rotation. Maybe a great moderation. Equities will get their own share going forward as sources are allocated away from equities, but maybe more moderation going forward. So let me establish this in a different comparative environment. I wanted to look at where that household cash was back in 2007, where it did back in 2009, and where it is right now. So maybe we can let the data tell us the story so we can interpret it. So when I look at the financial assets held by households and nonprofits, it's about 52 trillion in 2007. Now it's about 54. It dipped back to 41, but it recovered, so almost no change. You look at the equities held, it was about 20 billion, went down to 11, now it's back to 20. Again, the composition within equities have changed, in general, moving into more alternatives and such, but and also look at money markets. Money markets were about 1.1 trillion in 2007, went up to 1.5. Now it's back to 1.1. No change. But let me talk about where the change has been. When we look at the deposits, it was 7 trillion. It went to 8. Now we are sitting at 9. Meaning, especially the checking accounts, like 100 billion from checking accounts, now it's like 800. But is it cash available for equities? I don't think so. I mean, those people, they're not fundamentally equity investors. The opportunity cost of keeping cash balances is relatively low in a low interest environment. So I don't anticipate those monies are coming unless the opportunity cost of keeping that cash goes up. Which means more inflation, rates going up, more likely those cash in the savings accounts can go into higher yielding areas within fixed income. But also what has changed is I look at the pension liabilities on the S&P 500 companies. This is interesting because, as you know, the S&P 500 made its highs back in 2007. We recently got to the same highs, basically no change in the market levels. But you look at the pension liabilities, the companies in the S&P, they had about 63 billion surplus in 2007. Right now, they have about 330 billion deficit. What happened? Equity markets recovered, but people got scared, diversified away from equities. I call it they shut the barn doors after the horses left, and they didn't let the horses back in. But we are sitting in a lot of highly diversified, in my opinion, over-diversified portfolios, and people didn't benefit from this equity recovery. So if I take that the next level, what's on the other cash on the corporates, that's correct. Maybe I'll refer to page 20, which is a dangerous slide. The slide 20, please. When I look at back in 2000...
I didn't know we had 20 slides to tell you the truth, Mustafa.
It was... when I look at the cash back in 2007, it was about 800 billion. Now it's about 1.2 trillion. It looks like corporations have a lot of cash, and then you see Apple, Microsoft's, Google's, which is a very, very dangerous slide comparing to back to 2000. It establishes that there's cash, but this cash is not available. Mostly, it's outside United States jurisdictions. In order to bring it back and make investments, you have to pay the tax penalty. And the ones that are here, the companies, they were buying back shares, they were increasing their dividend yields, which the market is valuing higher yield or returning cash, but be careful. It's really, it's a very low growth or non-growth type of a strategy. It's not helping economies to grow to buy back shares.
Mustafa, I'm going to interrupt for 1 second. I agree with most of that, but you said something I think Alexandra might have a different opinion on. And I wrote this down because it's a quote. When I asked you to define sideline, you said lower returning assets seeking higher returns. So Alexandra, your grandparents started Lebenthal in 25 as a muni bond house, as I recall. I would say muni bonds right now are probably a lower returning asset class. Is that on the sideline or is it not?
It's not on the sideline. I mean, there's been money that has been pouring into muni bonds individually and into municipal bond funds. The returns on municipal bonds are really going to depend on what your tax bracket is. So if you live in California, if you live in New York, if you live in a high tax bracket state and you have a local tax as we do in New York, you're looking at returns that can be equal to 5, 6, 7%. So they actually are higher yielding. One of the things you obviously want to be concerned about is your duration risk, given that we are perhaps at the end of qualitative easing, perhaps not, but whenever it ends, I don't know that it's ending with a gentle bump in the night.
So
if I could just jump in, so I think that's really the more important question. I think we talk a lot about cash and whether it's 20 trillion or 30 trillion. I think the real important question is, what has created the incentive for investors to invest right now? And I think if you look at whether it's REITs, mortgage, commercial REITs, residential REITs, high yield funds, loan funds, a variety of other asset classes, there's been a tremendous amount of capital coming in, 30, 50, hundreds of billions. And the corporate cash is interesting, but it's really a sideline. And I think what's happened is QE3 in the US has tried to spur folks to come out into the marketplace, and we're just sowing the great seeds for the next big sell-off. There is this idea of liquidity is safety. Any one of us who are in the bond business, you can run the 10-year bond right now trading at 167, and if that were to back up to 250 or 350, which is a normal rate, what it should be, the amount of losses facing investors is an astronomical number. We've worked so hard the last 5 years to build up the housing stock and price in America. That's created about $3 trillion of wealth. But I think we're just sowing the seeds of a real disaster, and there's been products created, and there's been a false sense of security that things that are rated high, highly rated instruments or investment-grade securities or treasuries, that there is just a tremendous amount of pent-up disaster going to happen, and it's going to impact insurance companies, and if investors aren't savvy, it's going to hurt them as well.
So Jim, I want to stick with you on this question, and I'm going to come right behind that to Max. You mentioned risk aversion. People have become risk averse in some regards, right?
Perceived,
right? Again, people confuse credit rating with credit quality, and we sort of all know how that worked out back in 08, 09. Look, is it due to, and I'm going to give you 3 choices, then you can tell me, no, you're completely wrong, and give me your own. Would it be due to a financial crisis? Would it be due to what I'm going to call an apathetic yield environment? Or is it due to something systemically larger that I'm just missing, or other things, policy-driven, whatever? What's driving this?
I think it depends. This is not the economist's question. It depends who you are. I mean, for most investors, well, let's talk about institutions and corporations. I think because of the lack of government leadership, and if you run a large global bank today, whether it's Goldman Sachs or JP Morgan, the amount of cash that they used to operate pre-07 versus today.
You know, by the way, it killed me when you said that and you didn't. Go ahead, sorry.
But the amount of cash that those institutions, because of the overriding liquidity and regulation, it's a astronomical number. It's a number 20, 30 times if you were to talk to senior executives at CS or JP or Goldman. So there's a lot more working capital cash in the system. There has to be, because of the uncertainty. But I think it's a very poor, you're in a period of time where we have seen over the last 5 years a great reward in illiquidity. Everybody is running towards liquidity or perceived liquidity because they think it's safe. So I think it's a poor investment environment, and I think when people are really pushed and you say, what investments have you made money on over a long period of time, they'll probably say the more illiquid investments they've made, notwithstanding some smart asset allocation. So I think if you're a corporation or a financial institution, it's because of the regulatory uncertainty, the regulatory oversight, and the political forces that are forcing you to act that way. I think if you're an investor or others, it's just a very poor investment environment, very asymmetric risk.
I'm going to ask you the similar question, Max, but I want to set the table a little differently. Jim comes at it from the BDC perspective. They've certainly been recognized as a safe alternative right now, given the yield component. Now, Max, you run a global macro book, work at a very large, well-known alternative asset manager. When you think about the, quote, risk-off or risk aversion that we have seen, and in many regards, irrespective of, quote, the great rotation are still seeing, how do you qualify what's happening, what's driving it, and what the outcome of that's going to be?
I think, again, it depends on the sector, and I'm going to try to work in a disagreement with Jim on the answer. So in the banking sector, there is more cash, and as Jim was someone to agree with Jim here, clearly it's there because people want it to be there. The regulators have said you need to have more cash. They're not looking for higher leverage in the banking system. The investors in these companies have not been looking for more risk and more leverage in the financial system. So the incentives for banks have been, whatever they want to do, they've been told that they should not be getting a lot more risky. And that's ultimately a risk-averse response on the part of regulators to, I think, a rational risk-averse response from the global financial crisis. However, I think where I'll disagree is I think, while of course it could all collapse and destruction could happen, I think that broadly we've had, as QE has pushed people out of safe assets and into riskier assets and into some of the things that have been getting a lot of the inflows, I think that is broadly healthy. Like you have we've had the banking system, and it's like everyone wants to be money out there and productive. But we've told the banking system they have to be less levered and not more levered, so you have to get the money some other way. So the central bank has been trying to push people into it through extended zero interest rate policy. And I think, so if the cash is coming, but part of it's disintermediating the banks, that seems like that seems like the plan. That seems like a good idea. Not that there won't be certain assets that get overinvested or certain things that might go wrong, but I would have called that push of cash into those assets encouraged by ZIRP and by QE to be a broadly healthy thing.
You said a couple things that, for me, at least triggered a couple of other thoughts. On the one hand, and I agree with you, you said, banks have been told, listen, on my quarterly Fed audit, I hear how risky my behavior is and it needs to be ratcheted back. And on the other hand, we hear 2 weeks ago that the administration is saying, but extend more credit. And what we're seeing small and medium and minority-owned businesses are the ones that are actually being squeezed the most for capital availability. So I'm going to turn a little bit now. First, I want to talk about women-owned enterprise, since you are one, all due respect, and you finance many others. And then, Jim, I want to talk about the SME sector, because both of these sectors strike me as, when we think about capital being choked from the system for risk and for wealth creation and for expansion, those are the two arenas that are being hurt the most. So, Alexandra, why don't you kick off?
Okay, unless anybody else wants to tackle the women-owned question, I'm happy to cede the floor. Seriously. No, this is a fascinating topic to me, because for years, women have actually started businesses at twice the rate of men. There are 8.6 million women-owned businesses. They generate $1.3 trillion in revenues, and they employ 7.8 million people. They've grown 59% since 1997 versus 41% growth of male-owned businesses. And yet they have had an exceedingly difficult time getting access to capital, whereas regular male-owned startups, usually one out of every 10 startups, 20% get capital. With women, it's 13%, and that's up from 1% 10 years ago. Women usually have 4 times more meetings trying to get a bank loan, 22 times more trying to get access to equity capital. But what is so fascinating to me is that a whole kind of capital industry has arisen over the last number of years to meet this need. It started with Springboard, which was created about 10 years ago as a way to bring investors to women-owned businesses. And then over the last 5 years, you've had organizations like Golden Seeds, Women 2.0, Astia, and then just over the weekend, Lorraine Spurge, who I know is at this conference, announced that she's launching a $200 million fund to invest in women-owned businesses over the next 5 years. She's really kind of taking on the financial side, what Sheryl Sandberg is now bringing to the forefront, which in my opinion is that it is now the time of the woman. But I know from my personal experience starting a business in 2008 that it is extremely difficult to find access to capital. And the same does hold true for minority-owned businesses as well.
So Jim, again, I sort of view you as my proxy of experts on the small and medium enterprise. And that, the definition of small and medium, I think, has changed over time. When you think about your source of capital as an institutional source of capital for that entire sector, what are the implications for you? What's the implications for the sector? And what's the implication for the broader economy?
Well, just a point of clarification, of the capital that we oversee at Apollo in credit, about $60 billion, the BDC is a small part of it. It's about $3 billion. But I think what's interesting today is, the BDCs as a sector are 35 to 40 billion. It's really a very small percentage. What's interesting, what I see right now, the one thing that is ubiquitous and cheap is financing. 3 years ago, 4 years ago, a lot of middle market origination firms, a lot of distinct finance businesses started post the crisis. They could get the equity, but they couldn't get any of the financing. And without the financing, the return on equity didn't make any sense because it was a 9 to 10% business. In the last 24 months, Wells, JP Morgan, the big banks, they are lending, and the economics now make sense, and it's an interesting cycle. You're going to see these finance companies that started, and in 3 or 4 years, as the banks are in a better position, they'll end up buying these companies at 1.5 or 2 times book. But the point is, I think that when I see middle market lending and people say, well, companies can't borrow, I take a different view of that. I see what's going on right now, and I think there is capital for, yes, there's capital for the big buyouts, there's capital for syndicated loans. The average high yield deal is about 500 million, and many companies are borrowing 10, 20, 30 million. And they can find it, not only through BDCs, but they're not finding it through the traditional sources. We've talked about the secular change in banks. They're finding it through a lot of alternative capital providers. Some are here in various forms, whether it's alternative asset managers, hedge funds, or others. And there's whole swaths of business: the equipment leasing business, the aircraft finance business, energy mezz, which is a really domestic business. Those companies, I think they are finding capital.
And excuse me.
Yeah, so I think that there's a perception 3 years ago, but I think that perception's changed today. I think the reality's changed today.
Alexandra?
Just to add on to the small business side, actually small business administration loans are up 57% 2012 versus 2011. A lot of banks have actually added a number of small business specialists. And similar to the women-owned business with this sort of cottage industry, if you will, rising up, there are now crowdfunding, which has become sort of the latest and greatest. Organizations like On Deck, or companies like On Deck Capital, Biz2 Credit, Reality Mogul, Indiegogo. So, I think that's going to take the place of a lot of traditional lending for these smaller companies.
So I'm going to give them a heads up, because again, since I'm the step-in moderator, they had no idea what I was going to do. We're going to have a little bit of a lightning round at the end where I'm going to put them on the spot and ask them for a good investment idea. I will give them my views on the world, shaped by demographics and what I'm seeing in flows, but I'm going to give them probably a little bit of time to think. But before we get to those things, I actually want to switch to government policy. And I'm going to have, and since each of Jim, Max, and Mustafa either run large portfolios and or sit on government or management oversight of their respective global institutions, I want to get your views, and I'll start with you, Max. So look, we've seen fiscal policy and monetary policy. I'd like to say it's swinging wildly. It just seems really to be QE forever. And the folks that had the let's short the treasury market of, I think colloquially you would call it having their face torn off. So what is the impact to your investment strategy and your thesis on how you think about assuming or not assuming risk, given what's happening with fiscal and monetary policy, not just here in the US, but at central banks around the world?
So I think, as I mentioned before, I think QE has been broadly a good idea for the government to be pursuing. In terms of its impacts on investment strategies, I would say, so you've got this giant flow, and it's going to distort, giant flows distort prices. And there's broadly 2 ways you can play giant flows that distort prices. You can either kind of try to get in front or go along with them as you bet that they will distort prices more and more. Or on the day that they stop those flows, and they don't even have to reverse the flows, but if they just stop the flows, then the market impact of their previous purchases will recede. And you can play that side of it. So that side of it would be betting on rising yields. And I know for us, we have a higher degree of comfort with the second, just because it is, in both cases, it's in some ways betting on a market impact, but you're betting on kind of the right side of fair. You're betting on it moving toward fair value as opposed to further away from fair value. So this is not a big part of our investment strategies, but I would say those are broadly the ways to play it, and our favorite of the 2.
Jim, how do you think about that?
Yeah, I think we are not a global macro investor, but we are agnostic that the laws of economic equations have not been suspended, and QE2, QE3 is going to end. It's going to end in a bad way for many, many investors, and we are just trying to really bifurcate it. We're trying to either be very, very high up the capital structure, floating rate securities, great financing, or taking advantage of the secular change of banks and really filling in those gaps. So, going short is a hard instrument because the timing and duration of this could last a lot longer. But certainly it's our view that the ability to fill in the gaps because of the uneconomic lending environment or the uneconomic treasury environment is where you want to be right now. So as I said earlier, the theme of the last 5 years is having large pools of capital. I think the theme of the next 5 years, if not longer, with the secular change of banks, is having greater direct origination and being able to really fill in those gaps where many intermediaries in the past, i.e. banks, have not been able to, or had been able to, but not now. And really, the folks in the audience that are the pension funds and longer-term investors, they had really been benchmark driven on one side and alternative driven on the other. And there's a whole host of investors that are saying, I want to be in more opportunistic, 7 to 12% type of strategies, and I'm going to understand what the liquidity premiums are to do so and pursue those in a very logical but platform basis.
All right, I'm going to give a little bit more color before I ask you, Mustafa. It's the same question, but so Max from a global macro perspective, Jim from, I would basically say, predominantly a credit perspective. The name of your firm is Principal Global Equities, and you run a $4 billion equity book. So hearing what they said about yield and risk and capital availability, how has fiscal and monetary policy thematically or structurally changed or guided you in this last 2, 3, 4 year period?
Look, the stock markets, they don't like uncertainty. So resolution of uncertainty would be good. But where's the uncertainty would be coming from? Bottom line, actually, we like equities. I continue to like equities for the earnings, for the cash flow reasons. But I understand that it's going to be volatile going forward. Why is it going to be volatile? I believe it's more about the regulation uncertainty and stringent capital requirements are creating this type of a uncertain environment. QE is a short-term phenomenon. It's really for companies to be able to invest and make returns on longer-term capital. They need that visibility. You will see the additional regulation increases the cost of doing business. Hence, the stocks that we are picking, we are tilting our portfolios. It has been always avoiding anti-growth, anti-austerity areas so that we can identify marginally better growth at attractive prices. But the bigger aspect of equity management in the last 3 years, it has been about volatility management. It's really the strategies that first protect on the downside, but of course participate on the upside, creating these type of skewed return outcomes. The preferences would continue to be valued in the marketplace. I'm not talking about all the derivative related, but still good stock picking could help you achieve these type of optionality. Basically what I'm talking about is win by not losing.
So I've got a question I'm going to ask Alexandra and Max, and that is, as you think about fiscal policy morass we're in, or the QE policies that we're in, I'd like you to think about what's good, what you think has been done well by these series of administrations, and maybe suggestions for improvement. But before I do, a little audience participation so you don't fall asleep. Because when you were giving your response, Mustafa, it made me think of something. How many people watch CNBC? Be honest. It's okay, I watch it. Go ahead. All right, so volatility and skew, we forgot convexity. I think we've become, in terms of an investing world, a nation of jargon heads. Right? Every morning, well, I think we'd be better off sometimes to only look at our Bloomberg once a month. Then we'd miss some of the vol that you mentioned. And we'd probably be better off watching less of the media at times, with all due respect to any media folks that are in here, because we get caught up in jargon. I think we love jargon. So I'm going to go back now, because QE is a bit of jargon. You know my question. I'll start with you, Alexandra. Talk to me about what you would say, I like what they've done, or I think they should have done X. Give me some
Actually,
answers.
it's funny, just to add on to that point, my brother, who manages an equity portfolio for us, is a very thoughtful investor, and he was a lieutenant on a nuclear sub for 5 years, and that was where he got his investing prowess. And I like to say it was because he was underwater for 4, 5, 6 months at a time, didn't have access to any market data. I heard Roger Altman speak at a breakfast last week, and he said, interest rates would be much higher if the market thought that QE was going to be a problem when it's unwound. And I kind of scratched my head at that, because I don't think the market ever actually looks ahead. I think it reacts to what's going on today, tomorrow, and probably more of yesterday. I'm pretty concerned. I mean, I think that it's artificially raising the value of all assets, and I think that any investor is exposed to what happens when things stop, and I think it could be pretty ugly. I think you said that before.
Max?
So, I mean, as before, I mean, I agree it raises risks. I think it was worth doing. I think if you're not allowing banks to lend and you want money into the economy, you got to try to push it in there. And I think it was a move worth making. But I would also agree that it creates risks. And, as they were talking about in the first session yesterday, they were, basically whether this will generate enough momentum that things will finally get going and when they can get the pedal off, or whether it'll be a problem is unknown. So I'm kind of taking the lame middle road of I'm agreeing on the risk side, but yet believe it was a good, it had to be tried.
Jim, did you have a...
Yeah, I just think it's about moderation. I think it's gone way too far, and it's allowed the most important topic in America, the whole budget issue in the next decade, next 20 years, to be put on the sidelines as QE3 is taken over. And certainly when I think back in the 27, 28 years I've been in the business, the era of productivity gains, the benefit that did, the productivity of the internet and technology, now the benefit of oil, cheap natural gas in the US. I mean, these are big tectonic shifts. And I think that I have very little confidence in my partners, and we have very little confidence that the Fed will be able to maneuver this QE3 landing in any kind of rational manner. You can only think back to what happened in the spring of '94 when the markets were scant the size they are today, and the dislocation that's going to occur is going to be tremendous. And I think that QE3 has gone on way too far. I can see why Japan's doing it. I mean, it's been a decade of despair, or longer, 20 years, 18 years. But I think that this is really the polarization, and if we talk about polarization in DC, there's actually consensus. The consensus is let's not do anything until it becomes a crisis. And I think that it's gone way too far, and it's going to be unmanageable to land the plane. And I think that if there was real leadership in Washington to really take advantage of the coming crisis because of demographics and great health care, people living a lot longer, that would allow them to manage this a lot better.
Maybe I'll just jump in. Globally too, I think what I worry about is so far everybody's solution is to throw more stimulus in, all the governments, and then depreciate their currency. Currency is a zero-sum game. It's what Japan is doing great for their country, but very deflationary for the rest of Asia, even for Germany. So those are the things that the risks are building, in my opinion. And as it comes to our government, to be honest, I really don't care what they do, as long as they do something together for the good of this country and invest growth-stimulating policies. So that they can bring some of that cash back and with good growth, good returning investments. I think the markets in general will take it very, very positively. That's all we need. We need that uncertainty going away so that people work together.
In Jim's answer, he said two things that, sadly for all of you, got me thinking about other questions. One, you said the size of the market. And two, you talked about demographics. A little bit more audience participation. Who was involved in the markets in '87? Go ahead, admit how old you are. I'm that old, go ahead. Right? So in '87, to put it into a sense of magnitude, the average daily trading volume of stocks listed on the New York Stock Exchange was about 180 million shares traded a day. Now we generally trade 180 million shares by about 9:35. Right? That'll give you an idea of the size of the market. So, your point's well taken, Jim. I think people underestimate just the sheer volume of activity.
Well, also look at the Fed puts out every week or every month the balance sheet exposure to the dealers of government securities and corporate securities. And in the last 4 years, that's down 75-80%. So you have massive supply that's been created, and the pipe to distribute and trade and take on risk is 10 times smaller. So the dislocations are going to be sharper and more severe, and it's that's a perspective that we have in a global economy and trading environment of 2013.
Well, and you also mentioned demographics, so I'm going to give you a little bit of an early preview. I'm a big fan of the Philippines and Indonesia on the back of demographics. Philippines have about 95 million people. Average age 21, growth rate is 7% a year. Indonesia, 240 million people, average age 28. But I'm going to go to you, Max, because given your global macro, I think you're the perfect person to talk about demographics and how you think about demographics from an investment perspective and how it guides you or how you think about demographics when you make investment global macro decisions.
I think I'm going to have a short answer because it doesn't actually guide that much of our investing. But I would say broadly in the developed markets, to the extent we have views, they are, on the one hand, they would be negative GDP growth, not in an absolute sense, but relative to the last 100 years. You look at various secular trends that have happened that aren't going to repeat. Like an easy one would be women's participation in the labor force. Like you can't double that again or you're over 100%. And like there are certain things which have added a lot to GDP growth, which were great, but they're kind of one-time events. On the positive side, I think there's been a lot of research recently that there's basically equity returns have very little to do with GDP growth, and higher GDP growth countries don't have any statistically better equity returns. And there's both that empirical outcome, and I think there are some theoretical things you could say in support of that too. And so at the end of the day, on the equity side, for example, we don't look at certain countries and say, well, they're going to have a high GDP growth, and therefore they're going to have much higher equity growth. It may flow through certain things. It may lead to a currency trade or this or that, but we don't have a kind of an overall demographic theme.
Yeah, let me jump in on that. The demographics is actually only one leg of the three-legged stool. The other is, productivity and also capital formation. If you don't have those two parts, you won't get your demographic dividend. Meaning, these great crowded younger people, it means more famine and war. So that's really, you got to focus on the other aspects, how you get more capital formation as well as the productivity, which US demographics, when you look at the rest of the legs of the stool, is looking quite well. So when I also look at, don't get me wrong, demographics moves in a very long time period with our equity investment process. We're focusing in the earnings that we could generate in the next 2 or 3 years. So the changes are not that visible, but what we are observing is what the demographics is going to create and creating. For example, the shift from defined benefits to defined contribution plans. It has been a slow shift, but a positive welcome shift. The other things, the products that being liked, more yield-oriented, income-oriented strategies for the aging people, but there's also a danger associated with that. If you're just chasing yield but not looking for total returns, there may be some potential problems as the panelists start talking about. The other piece is inflation. If older people retiring, they're worried about their healthcare costs going up. But for inflation protection, they're holding commodities as a part of their portfolio. They will be up for a very negative surprise. So at any rate, we need much more differentiated, focused products to support these demographic shift. But I don't see that. I don't see that happening in the marketplace yet.
So, Alexandra, I hate to put you on the spot, but given your pedigree in muni finance, and Jim mentioned something that's interesting. He talked about underfunded pension liabilities and overextended municipals. I also know that you oversee the asset management side of your arm, so you have to answer this with two hats. Different demographic issues, but how do you think about them, and how does that guide what you advise institutional asset managers?
Well, first of all, there's been a lot of talk over the last few years, which a lot of you are probably aware of, about the municipal bond industry and are we headed for a great downfall? And I've been
Meredith Whitney says yes, by the way.
Yes,
right?
I'm familiar with that.
And she's been very wrong.
And yes, I'm familiar with that as well. And I have been extremely vocal in saying that. However, I am deeply concerned about underfunded pension liabilities. And if you look at the demographics and the changes that have been made so far to correct that, in my opinion, have been like trying to get rid of an iceberg by shaving off the top and making snow cones. We're not really getting anywhere with that. So I do have deep concerns, and you look at some of the states and look at Puerto Rico, which is in desperate trouble right now, to the point where they've even bonded out their debt service.
Well, they're especially worried now that John Paulson's not going to move down.
He was going to save the situation. So that's a great concern for me. When we're talking to investors right now, their focus is less on credit risk, and that's probably because we're only investing in high-grade municipals for them, and it's more about interest rate risk. So we're being very defensive with short durations with laddered portfolios. So I'm not sure if that was exactly the question.
It was helpful. So let me turn it over to you. We've got a few more minutes. I've got a couple more questions, but I want to make sure anyone in the audience that has a question has a chance to ask. Anyone with a question? Up here? Can we get a mic to this gentleman up here? Thank you.
So, excuse me. So taking it back to the cash on the sidelines question, I think one of the things that wasn't mentioned was cash outside the United States. My travels in Europe, Switzerland, you're obviously based in London, are the opposite of what we see here. We see individuals very uninvested in virtually anything. We also travel to Asia and find tremendous levels of cash in Asia that really can't find an investment home. And you see bubbles in property created as a result of that. I don't know if anybody on the panel has any sort of opinion on cash on the sidelines outside of the United States.
Yeah, so I'll paraphrase a bit in case folks didn't hear. The question focused on what about EMEA, what about Asia-Pac? There is clearly a tremendous amount of capital. Asia is a great example, the China or Hong Kong property bubble I think you were probably referring to. What impact does that potentially have on the investment opportunities or the risk-on appetite? Maybe I'll start with you, Mustafa, and then Max, I'll flip over to you from a global macro standpoint.
Look, higher cash kept on the balance sheets or even in the individuals, it's a function of either a low growth environment, you're not finding good alternatives, or really illiquidity or good alternatives that you cannot invest. So when I look at, say, Japan, that's actually is going to be a quite interesting investment or case going forward. For 20 years, with their deflationary environment, they had the highest cash on the balance sheet. They had no incentive to go outside and invest. Corporate carried a lot of balance sheets. We're going to see similar type of an environment for everybody else in Europe. Now we're going into a slower growth environment there too. What was different in the U.S. is we have a low growth environment, but the corporates were buying back their shares and putting it back to the earnings per share growth in a different way. So that's one aspect. Now, you change the opportunity cost of that cash, like in Japan, there will be a little bit more inflation. Now, it will be a quiet experiment to see how much of that cash will come out and look for investments, especially outside of their comfort zone, outside of Japan. So I think this is just function of a low growth environment. We talked about the confidence. The confidence needs to change. And before that confidence comes back into the marketplace with resolution of uncertainty, I don't think that people will be coming to that market looking for those high risk investments.
Max?
I agree, particularly on Japan. They clearly, both in the corporate sector and the household sector, have tremendous amount of cash that's been built up over a huge amount of time. They've been in no hurry to invest that in anything riskier, and whenever they have, they've been punished for it. And now we've got this huge experiment where the government is, going to try to buy all the government bonds and try to force people into riskier things, and we'll see how that. We'll see how much that actually moves into riskier things as opposed to just sitting in excess reserves. But there's certainly a huge amount of cash there, and it is, I think, the most interesting question. In terms of source of global cash, it's probably the most interesting source right now, given the size and given the experiment they're currently running.
So given, you each have different perspectives. Jim, I'd say you probably have the most direct interaction with corporate owners, corporate operators in your business model. Max, you're obviously a global macro. Alexandra, you deal in underwriting. And Mustafa, you're an equity investor. So I'll start with you, Jim, and come across. When you think I'd like to say I'm an equity guy, so what's going to drive equity market performance or what's going to drive the capital markets will be underlying company performance. But we sort of got to a situation where we trade on the news, we trade on panic, we're trading on CNBC, volatility flashes on the bottom. If I said, give me one or two things that you're concerned about that could impact negatively the capital markets and the equity capital markets globally, what do you think about? What worries you?
Well, as I've been clear, I think that the artificial level of what's going on in interest rates is going to create a great dislocation in the next 24 to 36 months. We follow what we do, not what we say. We at Apollo and many others in the alternative space, we are monetizing a lot of our equity ownership in a lot of companies right now. We're issuing stock whenever we can in terms of our portfolio companies. We're getting more liquid all the time. And because we just don't believe that these valuations in private equity at 9, 10, 11 times are a recipe for success. So, I also think that we are, so the overall dislocation that's going to occur is really imprinted on our forehead, and therefore we're trying to either
That's why you can't see it.
That's why I can't see it. But also it's the liquidity. I mean, back to this last question. There's a lot of wealth, whether it's in Italy, whether it's in Switzerland, whether it's in many countries in Asia or Latin America, and I do see a generational change of investors accepting liquidity constraints for higher returns. It takes many years, but I think that's going to continue to drive capital into the alternative space because the overriding returns in liquid strategies and getting quarterly liquidity, it's a very competitive space, and I think people are trying to say, how can I change the tide to be a benefit to me and not go along with the tide?
Max?
I think one of the most interesting opportunities and risks in current markets has been watching the flow of money from zero interest rates and from QE. And to set the stage a little bit, our general view is that investors do a little too much of bifurcating their money and their assets and their investments into a safe pocket on the one hand, where the most important thing is that it's safe and that the principal is there. And then on the other hand, a risky pocket, where the goal is not risk, but since that's where you need to generate your return, that can effectively be risk-seeking in that category. And that leaves neglected, on average, this stuff in the middle, the thing that's clearly not safe. Low beta stock like Procter & Gamble is not safe enough to be in your safe pocket, but it's not what you're going to dream of retiring on. And so on average, those things in the middle have been under-owned and undervalued and therefore have had higher returns. The interesting thing now, opportunity and risk, is that as zero interest rates have persisted, they have pushed an expansion in the safe pocket. So what was originally T-bills, then it's intermediate treasuries count, then investment-grade corporates count. And over the last year or two, it's even pushed into, and I think a lot of the money that you've talked about going to certain products has come from the expansion of what's considered safe. And well, okay, now we have to consider high yield bonds safe, and now we have to consider high dividend, low beta stocks safe. And so you've seen a tremendous outperformance of this normally neglected part of the market. And I mean, this year, for example, there's been a 5 standard deviation outperformance of low beta stocks versus high beta stocks. And it's not a one-day jump, it's just every day the low beta stocks outperform. And I think that's because of this policy just kind of pushing through and gradually, people don't go directly from T-bills to Apple stock, they crawl out this curve. And so, the risk and the opportunity are, I think it's late innings, not early innings, in these kind of lower beta, high dividend type stocks. And then you could really see it going either direction. If this keeps pushing people out the risk curve, then it's the high beta stocks. And if it kind of all comes to tears, well, then we're back to what's really a risk-free asset.
Well, it will come to tears. We're just not sure when, right?
And so, yeah. So I guess it's true in the infiniteness of time. But anyway, so we would do a kind of a barbell on that.
I'm going to refresh. Max started to get in, he sort of gave you his idea, I think his thematic investment idea. Let's go back real quick. Risk. What are you worried about upsetting the apple cart that we appear to be on right
Well,
now?
I'll tell you one thing I'm worried about, and we've been talking a lot about investors, and we've been talking, I assume, about institutional investors, and I've spent most of my career dealing with individual investors. Individual investors always do things at the wrong time, and they get caught holding the hot potato. Talking about Meredith Whitney, we saw when she was talking about everything and municipal rates spiked up, that was when individual investors were liquidating their mutual funds, and little did they realize that they were creating the problem and making it worse, because the more they sold bonds, the more the manager had to raise funds, and it just continued. So that's going to happen every single time the bubble bursts, and then that'll create fear on the part of investors. So that's something that deeply concerns me. The other thing, just quickly, is I am concerned about the economy and where we really are. We know the unemployment rate is certainly much higher than it really is.
So, Mustafa, I'm going to let you finish on that, but I was just recently in the Bahamas, and I had a taxi driver who was giving us a bit of a tour, and he was very knowledgeable. And so I said, what's the unemployment rate? And he says, we have 0 unemployment rate in the Bahamas. I said, really? He said, yeah, we just have 7% lazy people. Mustafa, what worries you? We're apparently on a pretty decent run in the equity markets. What are you concerned about?
Look, what drives equity markets is earnings. So, yeah, what creates the volatility is the macro uncertainty, but equity markets were running because the earnings were good in the US. Emerging is underperforming because their earnings were being downgraded. Their margins are getting squeezed because they have higher costs. So the bubble is not in the equities. Bottom line, what I'm asking is, what is going to make the earnings go down? Are we going to have another earnings recession? I don't think so. In the short term, in the next 6 months or so, I think we're going to run into a little bit of fatigue as it relates to some negative news, as it relates to this sequester-related job cuts. But look at the chart over there that's on there. The high cash flow yields are very, very supportive of equities. Bottom line, what worries me, what's going to make the earnings a negative surprise? More likely, there may be some pockets of equities buckets when we talk about this, like Max mentioned. Very high quality bond proxies, the valuations are overextended. So I would see a little bit of negativity in that type of a pocket. But otherwise, you look at the equities in general, I don't anticipate the earnings recession. Equities would be a good place to be.
All right, so we told you we'd get out of here right on time. We are, and I'm going to finish with our little one question. And I'm going to let you have more than one word, but not much more. I'll cut you off. Thematically, we'll start with you, Jim, and come down the line. You've got that 30 trillion. Where does it go?
I'm into longer-term, illiquid, idiosyncratic opportunities. So lock it up with a great alternative manager that can take advantage of dislocations over a longer cycle, not month to month.
Do you have subscription agreements that will catch up with you on that? Max?
Just what I said before, I would barbell it into safer and riskier and kind of stay away from the high quality stuff in some sense.
Alexandra?
I would invest in Lorraine Spurge's fund. I neglected to mention that women-owned businesses actually outperform male-owned businesses.
Well, we know they're markedly more rational. That's a given.
Yes.
Mustafa?
Global, unconstrained, opportunistic strategies that protect on the downside.
Great. So look, we appreciate it. We know it's right before lunch. We hope you enjoyed it. We enjoyed having you. Thank you very much. Thank you, panelists.